there should be transparency between the institution, this lending institution, and also the microfinance institution. Some people were telling that microfinance institution needs to be more transparent. Then we once again started talking to this microfinance institution. We could see that there is a gap. There is a gap of capacity possibly. For that reason, they are not that transparent apparently. When you go for the due diligence, in most of the cases, these people, this rating agency, they go there and they see that it is transparent. But whenever communication happens, then there is a problem in transparency. Then we started exploring how to overcome, how to scale over this problem. Then we started talking to Sudhir that if we can do a study on this, and Sudhir being himself as a veteran of this segment, so he agreed to do a study for us. And then we thought that let us bring this industry stalwarts and industry seniors to have a kind of observation roundup that this is what we have prepared and how do you see it? Do you think that we should be doing something add-on? Do you see that it is adequate, possibly adequate? And so this is what we are looking forward. So for that reason, we have organized a small, a webinar kind of thing where we have brought you people. And today we were happy to get Dr. Akhil Khan, MD Mitrata, and Mr. Anjan Dasgupta, CEO ASA India, then Mr. Sudhir Narayan, CEO MCRIL. He will also be the lead presenter, and then Sanjeev Singh, Bank of Baroda, and Mr. Suman Chaudhary from Equity Rating. He is Chief Economist and Head Research. Welcome you all. And after welcoming, I would like to hear from Mr. Momin for his forewords. Then we will start rolling on. Over
Thank
to
you,
you.
thank you, Saibal. Thank you, and good afternoon to all of you. A hearty welcome to each one of you for this quick meeting which we have organized. Basically, as Saibal said, it's a closed door kind of a meeting, very small group of people we brought in as a more of a round table kind of a discussion. We would like to hear and understand and learn from you. How do we build up a transparency manual which can be of use to the MFIs when they go for getting money from the banks and other funders? So it's more of it's an exercise to bring a transparency in the operations of the microfinance institutions and also present it in a way which is acceptable to the lenders. As Saibal has already talked about its background of how this whole exercise was initiated, basically from the lenders meet which we had a year before last, where we had a lot of discussion on the lack of transparency in many of the MFIs, needing to make it more transparent so as MFIs, the lenders can get a comfort in lending. So that was the base for the whole exercise, and we got Mr. Sudhir for doing this exercise. But we thought that before we make it a public document, we should get some kind of a feedback from the industry experts so that it will be useful to both the user MFIs as well as for the lenders also. So that's how it has been. That's how we are all here today. I'm happy that to see quite a good number of participation and quite senior level participation. So thank you so much once again, and I now hand over to Saibal for taking it forward.
Yeah, thank you, Mr. Roman. I would now request Sudhir for his presentation, lead presentation.
Okay. Thank you, Saibal. Thank you, Jesus. Thank you, Sadhan, for giving me an opportunity. Let me share that it was pride to come back to the microfinance space after a stint of 1 year with NBFC space. So when I was doing this project, I was taken a sabbatical from my work. I worked with Crystal for 18 years, then with MCL for 4.5 years. And then with Grameen Impact and NBFC, this is a social enterprise lending firm for a year. And during that stint, and me and Southern team are very closely working with the microfinance space for so many years. So Sebal and Sangeeta approached me and I said, I would love to do that. And that's what something which I've been doing in CRISIL and, MCL over the past so many years when in CRISIL we developed the microfinance grading tool parallel to ratings, which was taken over which was accepted by various stakeholders across the microfinance space. So thank you, Sadhan, for giving me an opportunity. What When I did this study, I was not having, there is no biasness towards any organization, either on the rating side or on the lending side. It was completely an unbiased opinion. The difference, the way I looked at, if I am running a microfinance institution, what are the challenges I will face and how I will overcome it. That was the intention. With that intention, that report has been prepared. During the process we started Saibal, we started somewhere in August 2023, and the first draft I was able to give you somewhere in November or December, which has gone multiple revisions based on feedbacks. So during this phase, I connected with private sector banks, public sector banks, development of financial institutions, uh, microfinance institutions, and NBFCs, non-banking finance companies. So total around 25, 28, either in person or in over a call, the interviews happened, the discussion happened. A longer discussion happened with few of them to understand how mid and small MFIs can raise resources, either debt or capital, over a period of time, and what are the challenges this institution faces. Okay, being in the rating side, developing ratings for CRISIL as well as looking forward for AMCL, we understand how grading works and what are the nuances, what is the difference between grading 1, 2, 3 or alpha double plus and all. I will come to that little later, but let me take you to a presentation. It's a 15 slides presentation, but I'm trying to give you a gist of it, how mid and small MFIs will be able to, that's my view based on the market conditions. So let me take you to the presentation. Just let me know once it is visible.
No, it is yet to. It is yet to.
Some problem here. Is it visible now?
No, it is not. I
Yeah.
think.
Now it's coming up.
Now it's coming up. Yes.
Okay. So the slide what we are given is enhancing transparency. That's what the theme is all about. We're looking at predominantly we looked at mid and small MFIs, not on the large side. Maybe around if you say AUM, maybe around 250 crores and below. Okay. Okay, so we will discuss. Anyway, the background has been given. I have key findings on governance, transparency, asset quality, repayments collection, and client profile, which is what I am coming from. I would like to understand from various other stakeholders. It is visible?
Yes, it is visible.
Okay, I'm not going to background.
Yes,
I
yes.
think Gigi sir and Sebal has laid out the background. Study was done predominantly for the mid and small MFIs. I'm not going to that. I'm not going to objectives also. Let me talk to you about the current scenario. Okay, the current scenario is, as you all know, 85 to 90% microfinance portfolio is being garnered by the larger institutions. The mid and small MFIs faces challenges on governance, management system, micro data. And as I told that, I have done interviews with around 27 participants, inclusive looking at all the stakeholders, including a rating agency. Okay. Okay, so this is basically a criteria for DFI. All these are public documents which I have taken it. None of the institution whom I have spoken to they have shared their personal data, or either on a call, or they have shared with this data, or they have shared with us. They said that public document. So most of you guys know that. Most of you will know that this is the requirement, or if the requirement has changed, we need to modify it. But this is the requirement from a development of financial institutions perspective. Minimum net worth of 10 crores, leverage debt to equity of 5:1, capital adequacy of 18%, RBI guidelines is 15%. I'll go a little fast, but these are all the basic things. I'll come to the crux one, which will later spend some time with you guys on that. Okay, some banks insist on a hypothecation of 1.33 times, and microfinance. Some banks also insist on risk management policies, detailed risk management policies. Okay, so these are the mandatory criteria. I'm talking about banks, which includes all banks, including SFPs. 3 full year of operations, profitability during latest 2 years. Someone says 1 year, some says 3 years. So I take it as an average of 2 years. AUM of 100 crores for PSUs, 250 crores for private banks, 500 crores for NBFCs. They will start investing in this company, in these in NBFC MFIs if you are 100 crores, 250 crores, 500 crores AUM. Okay. Investment category of triple B minus and above. NBFC requires a higher credit rating. The NBFC MFI should have strong capital position, portfolio risk less than 4%. Rating assigned by the top 3 rating agencies preferred is what a couple of them has told. Either the third or the fourth lender, not the first lender. A couple of them have said that we cannot be the first or second lender or third lender. We should be the fourth and the either the third or the fourth lender. Okay, I'm talking about banks. Now I'm coming to rating agencies, what they look. Diversified governing board, strong second line management, profitable operations for 2 years, 3 years, superior capital base, robust MIS, expanded operations, strong collection mechanisms, which they also look at demand collection on a parallel when you look at the repayment rate. Diversified resource profile, which means that you should have debt, you should have capital resources, you should have NCDs, you should have all other capital market instruments as the borrowing profile. Seasoning of borrowers, vintage of borrowers, also they look at it when they look at the rating or the grading. Robust risk management practices. Okay, so when I spoke to lenders, they said these are the few challenges: operational and financial transparency. Most of them, they don't understand what data is coming from the microfinance division. Data asymmetry, capital adequacy ratio, loan portfolio analysis. They say that we get only one loan portfolio analysis. How can we differentiate it in a different format? So they're looking for product, sector, district, branch, rescheduled portfolio, return of portfolio, management information system, and rating and grading. So most of the lenders are still not aware how rating works and how grading works. So rating is a credit rating instrument. It's a credit instrument. It's a capital market instrument. Grading is for an overall organization. Okay, so that's the opinion which is coming from ground. MFIs faces governing board, second layer of management. Mid and small MFIs have limited governing board, second layer of management, moderate management information system, limited knowledge on difference of grading and grading. So if some bankers say that you have to get rating, they could do grading. If they say grading, they do rating. So there is some ambiguity from the MFIs also, which I felt that when I was speaking to very small ones on rating and grading. And different operational and credit policy for different lenders. So A bank, public sector bank will say 100 crores, B bank will say 150 crores, C bank will say, okay, double B is okay with me, but that's an internal discretion. So, okay, so there are a lot of, within the banking, within the lender's perspective, the policies are different for different for MFIs. Okay. The key findings on the government base, this is coming from my experience and speaking to various lenders who have portfolio on microfinance. Conflict of interest, number one. Number two, friends and relatives as board members. Board members have limited knowledge on overall operational performance. Board members are not able to provide strategic directions, or all the board members are not part of various management committees. Independent, some of the lenders said that independent directors are not to the extent of 40%. Some of the lenders say that board members are very rigid in terms of change in processes. So if you say that MIS, I want to understand the MIS, the board member will say, no, I can't reveal that. That's an proprietary tool for us. So this is what the bankers and various other stakeholders have told about governance for microfinance institutions on mid and small MFIs. I'm repeating mid and small MFIs. On transparency, I believe that microfinance in India, as I was telling some time back, has been very reciprocate and has adopted changes thrown to them on a very short span of time. Uh, uh, at the same time, they have adopted these changes uh, very rapidly. But what I felt was they were not able to differentiate themselves from the other microfinance institutions, or from the if something I need, if I'm doing something good, I need to showcase to a lender saying that this is what I'm doing good, or this is what my weaknesses are. So you yourself are telling strength.
So we need to collect that letters which we are sent.
Okay. So
Mr.
here,
take us. Carry on.
nice, Abel. I think you can connect. You can speak. Okay, fine.
No, carry on.
Okay. So when I was part of the rating mechanism, there is a, if I look at a grade of, say, MFR1 or alpha double plus, or MFI1 or SM1, between 1 and 2, the variance is maybe between 10% or 15%. Okay. When we are looked at a rating at that point of time, or the grading at that point of time, we would have said that you are on the bottom of 2, not on the higher side of 2, which will lead to 1. So I'm giving a sense how the microfinance institutions interpret the data, interpret the rating. Next year, if we again do, again it will be 2, but it will be at the middle of the 2, very close to 1. Okay. Then the microfinance institutions will come back and say that we have increased the portfolio, we have increased the geographies, our PAR is good, our board is good, still I am getting 2. Okay. So it is important for an MFI, and it is also important from a rating perspective, or an agency which is evaluating, disseminate what moves, what is the movement, how the grading will move, and what level. Therefore, when I put down the criteria of what rating agencies will predominantly look at, it is on a broader theme work. For instance, let me give an example. If a mid-small MFIs, mid-MFIs come back and say that I have in 5 states, okay, and that's diversified operations, maybe around 60% in one state, and then move towards different states around. I'm trying to move towards different states, and that's diversified. I am geographically diversifying operations. But the agencies will look and saying that your still concentration of portfolios around 60%, which is higher in terms of book. So the rating grading will not move because of that diversification. It will always support that move will support the rating, but it will not shift the rating to upwards. Okay, so that is the crux of it. So that is what the microfinance institution should take into account. And if there are policies stating that one state will not have, I will move from A state to B state to C state, and one state will not have at any given point of time more than 20% or 25% of the portfolio. That's the organization policy. Okay, so that's the organization policy which you're keeping a slab on the states. So which is looked from a different level. So what I'm saying is that when we look at, when the rating agency look at it, it goes into micro level understanding how the risk is mitigated, what are the new risks which is going to come in, how are you capitalized, and all of things come into picture when they look at the rating or the grading frame. Okay, now I'm coming back to transparency. Now, what I understood is that most of the mid and small MFIs are doing fabulously well, but they are unable to raise the required resources. banking system or the financial institutions. How we can differentiate that? What are the differentiate factors which will play an important role? If I am running an MFI, if I am responsible for MFI, I will go and say that, okay, I have data of say 50 crores. This is my urban portfolio. This is my rural portfolio. This is my district profile where high risk, high, medium risk categorization I have done internally based on the industry benchmarks. These are my first time borrowers. These are my repeat borrowers. These are my borrowers profile on loan cycles. This is my repayment rate for which is collection rate, which is coming on time. This is little bit delayed. This is say 95% is on time, 3% is 1 week delay, and the remaining 2% is coming after 15 days delay. Okay. Uh, Based on that, most of the MFIs are looking at are doing provisioning norms much better than the required norms. But in terms of write-offs, I can understand from where you guys are coming in. You are coming from the profitability, and that needs to be reflected, saying that if you tell that I've not made sufficient profit, so write-offs will happen next quarter. So which is understandable from a third-party opinion. And reschedule the portfolio. So when we looked at reschedule portfolio, we are not, when I was part of the rating team, I'm talking about prior, we were not getting the rescheduled portfolio data correctly. So we have to go back, collect the data multiple times, which a lender at the end of the day believes that the data which is coming is not correct. Okay, so we need to be the MFIs need to be very careful on this data. And please, if you have rescheduled portfolio, suffice the data. Okay. Now coming to the crux of the entire lending from the lender's perspective is asset quality. Asset quality, there are two things, asset quality and capital adequacy. So if something happens to asset quality, how are you capitalized? And how your asset qualities are moving. So I, based on my experience, try to, demarcate or, categorize into various sectors. So can we do region branch-wise categorization? Can we do borrowers as par analysis? First time borrowers, how many first time borrowers are defaulting? How many second time borrowers are defaulting? How many third time borrowers are defaulting? And understanding why. Okay, sector wise, agri, trading, business activities, commercial purposes. So if you have asset quality segregated based on this sector wise, product wise segregation of asset quality, and tracking hidden delinquency. What even today, when I go to the field, I have seen that the borrowers in the group comes together and pay the money. So if it is 100 rupees is coming from the ground, 100 rupees comes to us. But there is an post-COVID, there have been a lot of challenges microfinance institutions are facing on ground to bring this group together in one place, to center meetings, or technically it's a center meeting where the attendance has been looked at it very rigorously in the past. Now it is diluted to a larger extent because most of the members are working members and they go in the morning and but the payment comes, the attendance is not there. In that, we are the institution is unable to track it, which borrower has paid, which borrower has not paid, which borrower has has depended on their group mechanisms to pay the delinquent the EMI for that particular quarter or for that particular week or that particular month. So that hidden delinquency tracking is important just to understand whether this borrower is really facing some external factors, challenges, or this borrower, is tend to doing it intentionally. So that helps the microfinance institutions to track it on that bit. There was one recommendation on real-time loan monitoring systems to lenders to build trust from one of the large lenders onto microfinance space. They said, if real-time LMS is there with us, we will be able to track the data. Okay, so that is also captured here. Now I'm coming to repayment data dissemination of timely collection. So please remove prepayments and overdue when you are collecting on time. Look at product-wise repayment, look at sector-wise repayment. Try to come out with these reports to a lender and tell them that out of my entire portfolio, 95% is green, 2% is amber, and 3% is red. And then let's look at from that perspective whether the financial institution is coming forward and lending it to you or not. Okay. So similarly, you also need to understand, also need to put some data on client profile, client attrition. How many unique borrowers are there? What is the attrition rate of the borrower? How, whether one product has been looked at from a various borrower cycle or not. Can we do a client profiling based on loan cycles? Can we look at how many borrowers have missed their payments and how the pooling happened? That's nothing but hidden delinquency. And internal audit mechanism, which I felt at that point of time for mid and small MFIs, because of their size, limited bandwidth is given, internal audit mechanisms can be strengthened further. So that's it from my side on my report, which I prepared and given it to Sagar for discussion.
Yeah, nice, sir. It's nice presentation.
Yeah.
Thank you.
Thank
Thank you very much.
Thank you,
There is a,
everyone. Thank you for patience
thank
hearing.
you.
I am open to any kind of.
Thank you, Sudhir. So Sudhir is here to answer our queries, but there is a request that if somebody is not speaking, please keep yourself mute. It helps us to communicate properly. So now, I mean, we have seen the report, and it has a it is multi-dimensional. So there is this lender's perspective, there's microfinance's perspective, there is this rating agency's perspective, everything. And fortunately, on this platform, we have everyone. So I will go to everyone to understand their perspective, the parameters which Sudhir has come up with, whether it is adequate, whether it will help us to raise fund, and whether it will help us to build up effort, primarily to build up the transparency between the lenders and the MFIs, or there will be some problem. In many cases, we have seen that this microfinance institutions, they really want to be transparent. They want to show the real picture, which is not always palatable for the this your lending institution. So they also, because they have the need on the ground, the people need money, they want to support. So in that case, they want to try in a different way. So, I mean, this is everything said and done. So for that reason, we have started this initiative to bring up larger transparency in this segment. I mean, I will first go to Mr. Dasgupta because he has also a meeting within some time. So, Mr. Dasgupta, for all of you, I do have same question in the first round, that do you think that these parameters are adequate? Secondly, do you think that we need to do something, or in achieving these parameters, there are certain problems? So these are the three questions I would like to know, I mean, understand from you.
Thank you, Shoibal. Thank you, Gigi sir, Shoibal, and all at Sadhan for organizing this. Thank you, Sudhir ji, also. I mean, it was a wonderful presentation. You have been in this sector for very long. So you've covered everything, right, from rating agencies to the bank's outlook and how the institutions can actually provide various data which will help them get the lending. So, I mean, at this moment, I think I'm one of the appropriate person to be in the panel. I had a borrowing of 1,100 crores, out of which I have paid 1,500 crores without any significant borrowings coming in. So that makes you the most eligible person, to talk about this topic. Without a default, I have done this. So that credit goes to my organization. I mean, when we were young, we had seen. I mean, let me take it on a humorous count. Like I saw a T-shirt. On T-shirt, it was mentioned, good people go to heaven, bad people can go anywhere. So it is like that. Good governance, you have best of governance, you have everything in proper place. But somebody else goes with a data which cannot be the data, and he gets the loan, and we keep waiting outside. Hamara number kab aayega. So that's the situation. So it's very important yet that transparencies are maintained. But again, the ratios and standardization the ratios also require some kind of standardization. I think Sudhir also covered it, that we must show the data to the banks, in which we must show that what advance installment has been received, what is prepayment, and what is the current payment, which shows the actual recovery rate. So that's a right approach. But what actually happens is many a times the banks and financial institutions, they are happy with a 99.5% recovery rate, and they don't bother to go into the pixels of the data. That actually affects, let me give a real life example too. When it was the second wave peak of COVID, I was asked that in Odisha, you are having 70% recovery. Yet another partner is showing me 99.5% recovery. So that means your efficiency is down. I just answered to them that best of luck to you, best of luck to your partner. For me, it was not possible. But ultimately later on they took a 40 crores hit in that company, because the company had all fictitious loans, and the recovery also was fictitious. So that is where it is. It is also important for the banks, financial institutions to go into the data, whether it's achievable data, whether it's a rational data. In fact, here Sadhan plays a very important role too. Sadhan has been publishing various factual data all over the COVID period, which actually did not match with any individual, many, I won't say any, many of the companies' individual data, where the recovery rates were shown much higher, the PAR was shown less than 1%, and NPAs were shown less than 1%. There the industry data needs, a need for education to the banks is also very important, to actually make them compare what is the industry data and what data is being submitted by individuals. No point banks coming cribbing later on, that I lost the data, I lost so much of money in that particular company. My example that I gave is one such case before. Policies also need to be in sync. While Sudhir has rightly pointed out that there are some institutions which say that profitability has to be there for 3 years or 2 years, he has averaged it out. But unfortunately, tell me, if a bank or if an institution is making a true provisioning, a true write-off, is it possible in the COVID year between the 3 to 4 years to make a profit? Which is highly unlikely, and then especially in the East, when you're having the Assam, you have the COVID and you have the overlending situation. The East is heated up much more, so that's the issue. So you cannot have a one size fit all solution all over India. Each regions will have their own issues. At various points, various regions had various issues. This time, East suffered the maximum. So the policies and whatever the institutions are taking, lending institutions, that also has to be synced with ground reality to actually look at it in a different perspective based on whatever events that have happened in the particular region. Then we are talking about governance and fair practices at organization level. On the reverse also, it is true that we also need to see the governance and fair practices of our lenders. COVID has thrown it up. I'm being harsh, but that is also very important. And for this, all MFIs or the borrowing institutions need to share data about their experience with any lending institutions. We had cases during the COVID, even just as the COVID started, there were institutions who said, give us additional fixed deposit to cover the future risk that is going to come in, which is not fair. Absolutely not fair. In fact, we decided to return the whole of the amount, saying that no, your agreement does not talk about 2 fixed deposits. 2 installment fixed deposit. So it's better that we return your whole of the amount, So those are issues there. There are issues where the lending institution during a black swan event should come in, protect the organization, not withdraw. So there are institutions which have withdrawn also during such events, causing more harm. It's a known fact that in microfinance industry, if you're not lending further during their crisis period, it sends a wrong signal other group members to start defaulting. So virtually you are putting the organization into serious difficulties. So these are my few thoughts. There are many more. I can go on and on, but I would love to give others also a chance to share their experience. Thank you, Shoaib, for giving me this opportunity.
Thank you, sir.
Thank you very much, Mr. Dasgupta, for your candid observation. So one thing that we could understand, the parameters which we could dig out in these studies are apt, but from both of the sides, it has to be very clear. It is not only microfinance institution, the other side also need to be very clear about what they are expecting, what's their understanding, and what's they're expecting. Thank you very much. So I would like to go to Mr. Sanjeev Singh, GM Bank of Baroda. Mr. Singh?
Yes, good evening.
Yeah. So, Mr. Singh, now, you have seen the presentation, you have seen, you have
Yes.
heard the observation. What's your view on these parameters, which we could dig up that the banks are asking for that a minimum of 100 crore. So what shall the smaller institution would be doing in that case? Is it really right to ask that one? Because we always, more than like around 60% of our fund is coming from bank. And we are also seeing that 30% of Indian geography is, is shortfall, is having shortfall of your PSL. Everything is over there. So if we tell that, we won't be going, we won't be, lending if the institution is not having 100 crore or, this kind of rating, specific rating, then what will happen that, many a cases, the smaller institutions won't be evolving. And we need a lot of these your localized institutions to be there on the ground to support this financial inclusion objective of government. What's your view on this? Uh, I'm not putting
Yeah.
you in tight corner for sure.
No.
I want your very candid
So,
observation.
first of all, thank you very much, Sabal and Team Sadhan, as well as all the people very experienced from external rating agencies to running the microfinance institutions, right? So all you rightly said, everybody is on the same page. Mike, I am going to ask you a question that before we start for discussion, that how to fund a company which has not reached to AUM level of even 100 crore, right? So go back to that. How to fund a startup microfinance company, right? So the criteria is that until and unless you have a system to identify who is the potential microfinance institution. I'm very happy with the presentation of Mr. Sudhir because it covered each and everything. Couple of things more if you can add on this. RBI has to come into picture because see whether it is a public sector bank, private sector bank, internally they have certain policies, but based on the external policy recommended by the regulator, right? So one of the limitation we face as a financial institution is a sectoral cap, right? The capping is there. So microfinance institution, every financial institution has certain kind of capping. Let's 100 rupees capital, you can lend up to 5 rupees only. Out of microfinance, 15 to non-banking finance and 25 to MSME kind of a thing, right? So there, my suggestion will be that you need to have some kind of forum, some kind of message going forward to the regulator also to increase the cap, maximum cap amongst all the financial institutions so that they will have a little room to lend, right? That is number one. Then coming back to the number two criteria, that is the underwriting parameters. Whatever you have rightly mentioned that there are two type of categories in microfinance. One is that is a very large microfinance institutions where each and every of your presentation, each and every slide fit into that. they have adequate capital, their delinquency ratio is also less than 1%, right? Their presence is more than 5 Sorry?
No, it's fine. Please carry on.
No, I'm getting some boy. Okay, no, it's fine. So their rating is also either triple B, A, double A kind of a thing, right? Because they belong to a very big group. So rating agency also give due credit which group they belong to, right? So if it is if it is like a Ananya Birla Group kind of a microfinance institution, right? So rating will always be best, right? And definitely the corporate governance. So now the biggest challenge we as an underwriter face in terms of many of the microfinance institutions, mid and small, basically, where corporate governance is lacking, right? Transparency absolutely is lacking because you don't know the way, and there are not much industrial data or analysis available to have a comparison. When you lend to any large corporate, say textile or cement industry kind of a thing, you get a peer-to-peer comparison, 10-page report you will get, right? Exhaustive analysis you can get, and that will be very helpful in terms of underwriting. So the challenges for the mid and small microfinance is a lack of a strong governing body is always there. Transparency is one of the factor. Asset quality and the portfolio at risk part. So these we are talking about those microfinance institutions which do not have access to such a robust data, such a training also. So going forward, what is my take on away? We also want to learn more and more microfinance institutions coming forward, because the genesis of microfinance lending is joint lending group, right? JLG concept kind of a thing. 20, 30, 40 people coming together, doing some kind of activity, generating some amount and then depositing it to the microfinance or whosoever the lender they have lended. So this is a very noble thing, but lot of work required, right, from the regulator to the financial institutions to do further deep dive. I will say a little bit of relaxation, both in terms of external rating for microfinance institutions also, and from the bank point of view, underwriting model also need to undergo a lot of revamping to accommodate these mid and small microfinance company. You cannot compare mid and small finance company with a large MFIs in terms of any of the parameter, whether it is in terms of AUM, whether it is gross NPA, net NPA, capital adequacy, number of customer, the state they belong to, urban, semi-urban, rural kind of penetration. It's a beyond comparison, at least till the time they become a large MFI, right? I'm just talking about from the starting point of view, and from, let's say, give them time 3 years, 4 years, 5 years to grow and to attain a stature of 1,000 crore AUM or 2,000 crore, 3,000 crore AUM kind of a thing, right? So in data, industry-wise data for microfinance institution, I would suggest to have a much more robust platform should be there, so that each and every minor detail. Somewhere I have seen that it is mentioned that charge on the MCA, right? Microfinance institution charge, that is not reflecting, right? Then or how to check the fictitious. The gentleman was telling that they have created a fictitious loan book, and then if the loan book is itself is a fictitious, it is going to be 100% write off only in a period to come. So these kind of thing, if it is recurring in the society, in the country and the economy on a frequent manner, so it need to be curbed, right? So what are the ways and how to do it? So one thing is that training of those small and microfinance, if I would suggest that a big, large microfinance institution should come into picture, handhold them, train them, mentor them. So kind of a committee approach, if we can form where these people will provide the standard based practice available in the market. So ultimately, whatever, even a 1 rupee we are lending to somebody, we need to be rest assured it is going to come back to us with a minimum default, right? Minimum possible default. And it is only possible only through the organized and correct data. If we have an organized and correct data, Yes, somebody is at a very, very mid level right now, but we can guide them. We can mentor them, help them how to become big in the time to come. If you want to take more funding, either in terms of equity funding or in terms of debt funding, you have to have your financials at par with the big microfinance institutions, right? So right now there is a challenge not only with us, with all the financial institutions that are underwriting in the absence of big sectoral cap, right? So sectoral cap need to be increased, and a mandate kind of an approach paper from the RBI is most welcome to all the financial institutions, diluting some of the hardcore parameters, giving them some cushion, 2 years, 3 years, 4 years time. Let's say 10% capital adequacy over a period of 3 or 4 years. You have to come back to 15% or 16%, 17% kind of a thing. So certain these things, I think, will help us and all lending institutions to come aggressively in future, put together. But yes, the best practice, each one of them to have to adopt, and the areas which Mr. Sudhir has covered, we need to further deep dive, extract more industry-wise data, make a comparative pictures, and then everything is covered, right from the corporate governance till balance sheet analysis, right? That asset quality kind of a thing, everything is considered. So if everything is in order, we have a very limited risk to take, right? So we would like to take risk on a very a kind of exposure which is more secured in nature, right? And we is paid in time. So these are some of the thoughts I wanted to share from the lending perspective. Anything else? Yeah, I would like to.
Thank you, Mr. Singh. One thing I want to understand from you, whatever you have told, that you're talking about this transparency. Where do you think that the transparency is not there?
Transparency is not there in the sense that I'm talking specifically about the mid and small microfinance, right? They don't have access to so many data, so they will give a broad data like yeah. So even their 15 crore, 20 crore, 25 crore customer base, 25 crore AUM kind of a thing, if they come out with the data, it is not a robust data. It is not segregated into area wise, village wise, district wise, and the district wise recovery rate, area wise district recovery rate, and then what is their future plan, right? What is their ambitious target for next 5 years, where they want to grow from here right now, which model, how much tech savvy they are going to be, what is the cash component both in terms of lending and in terms of collection, right? If it is 90% cash disbursement and cash collection only, so that model I don't think it is going to be sustainable in long run. So they need to so a lot of these kind of data is missing. And of course, the asset quality, I mean, the financial health in terms of capital adequacy, in terms of no doubt is very small, right? Profit margin is very low. So now, and that's why somewhere he has maintained some kind of a corporate guarantee, kind of a personal guarantee, kind extra cushion, extra comfort is given to the underwriting institution. That will help. So that transparency kind of thing I was talking about.
Thank you very much for your
In fact, let me just add to that.
Yes,
For
please.
information, Mr. Sudhir has come out with a very detailed data sheet along with his report. That has not been presented. It's a very detailed report. In fact, I was
Very
a bit scary about that data sheet because it is so detailed. I was wondering whether how many of the MFIs can really fit into that. So it's not that it's not been taken into account. It is taken into account. It's there. So basically, this was to bring transparency. The whole exercise was to bring a exact transparency into the operations or into the application of the MFIs. So that details are already being proposed by Mr. Sudhir.
No, that's okay. I fully appreciate that data is there. That's an exhaustive. That is the pain point I'm talking about. The complexity of data need to be further fine-tuned, make it in a very streamlined and a very easy way, accessible to each and every MFI, right? And they can also think this is the standard parameter, I have to reach to that. So these practices I have to adopt on daily basis, whether in terms of having a robust board of directors kind of a thing, and excellent corporate governance, and hiring good talent in the market, and these kind of so many things are there,
Right.
HR and non-HR related. So these data need to be then presented to somebody who can take the decision, like RBI steering committee kind of a thing. And then a lot of revamping is required. Simply just discussing the things, transparency in the thing. If you want to really bring a revolution in that, possible, it is possible. Model is sustainable, but we need a lot of groundwork, lot of overhauling. That is my view.
I mean, yes, you are right. But thank you, Mr. Momin, to bring that point that we have also developed along with this one. We have already developed a manual that which are the areas we need to be transparent, which are the things we have to put in. So it is already there. So, Mr. Singh, I would be definitely looking forward for your observations on those. Mr. Singh, one thing I am very happy that you have put forward is this RBI's policy. I mean, many of the bankers, they have told that we have exhausted our limit. So I cannot support, even if the smaller institution I want to do it, then I cannot do. But this, when you're talking about this equating between this small and big MFIs to lend them, we are little bit troubled because what we have seen that, I mean, lately banks are also going towards a little bit bigger institutions are keeping us giving us a little bit of trouble. And Dr. Akhil is laughing. I know that you have something to tell. I mean, I would definitely be looking forward to you, Akhil, for your observation on this. First observation on the parameters, second, your observation, your experience on this. Yeah, over to you, Akhil.
Thank you. First of all, thank you. Very crucial subject for webinar and need of the hour. So thank you, Sadhan team, G sir and Dr. Saibal. What Sudhirji has present is Sanjeevani Booty. And I think it should be given at the birth of the child rather than when Lakshminji got Murchit, to wake him up. So I think some of us will be needing it to awaken, and get our energies back. But I wish it was available 5 years or 10 years down the line or 15 years down the line, which could be the guiding tool from day one. I would, before I go into my detailed comments, I don't want to miss addressing to Mr. Sanjeev Singh. Sir, if the small and medium MFIs meet all your criteria requirement, what Sudhirji just has mentioned, are you going to give us debt on a lesser rate of interest?
My question to that, are you going to lend at a lesser rate of interest to
absolutely.
to onward lending? Your onward lending, what happens that if we give microfinance say X rate, you charge a lot of premium out of X. That's why your profit margin increases. No. So like RBI giving a repo rate linked loan, RBI expect that when the repo rate goes down, the lending rate should also go down, right?
Absolutely, sir. Absolutely. And under the government credit guarantee scheme, which gave opportunity to small and medium MFIs, and Mitrata was one of the lucky ones, and we have relationship with you already.
Yes,
we got cheaper rate of interest, and we passed on that benefit during that period to the beneficiaries, to our customers. But after the credit guarantee scheme was over, it is back to square one, that it's the commercial rate of interest. So I think the MFIs have demonstrated that if we get cheaper money, the benefits can be passed on to our customers, and there's no doubt about that. And that's where the transparency comes into the discussion. So absolutely, I can assure you on behalf of small and medium MFIs that if we get cheaper money, we'll be most happy to pass on to our customers.
So just sorry to intervene you. That's why I said the RBI policy, like various kind of product RBI is coming out with a spread, right? Minimum and maximum, this much you have to charge. So these kind of changes required from the regulator point of view also in order to promote the microfinance, like we have done for the MSME. Right. So many rehabilitation packages there for MSME. And you see, ever since this package has come, you see the turnaround in MSME. It is growing like anything. Last couple of years, 2, 3 years, 4 years time post COVID, they're all again back to their normal growth. Right. Because of these incentives. So that's why I said that the RBI, if intervene, then bank is compelled to do that. Don't worry for that.
Great. Thank you. Thank you for that assurance. And for Sadhan, going back to regulators being our SRO, the mandate is with Gigi sir and Dr. Saibal. Coming back to what Sudhirji has present, I think absolutely fantastic. And I think when I was listening to that presentation, I got two messages. That if we are starting, if as a promoter, I'm launching an MFI, I need to work on building a very strong, robust, transparent institution on one side, and I need to be profitable and have systems and operations to show my growth. I remember when I went to RBI to get the license, the CGM there asked me, or the DGM asked me the same question. Why do you want to be a promoter of an MFI? And what is your vision? What you're looking forward to? Just to make money? You want to make an MFI? That's the notion which is getting developed. And I think it's very, very important that the governance issues which has been discussed, the robust operational issues which has been discussed, the IT MIS issues which has been discussed. Any lender has an expectation and it's not unreasonable, let me assure. And on a positive note to all our participants, I can tell you I am a small and medium MFI. We have been able to raise money from PSU banks, from NBFCs, NCDs, and also ECB. We had our first external borrowing from the French bank. Now, we are very small to have such a diversified instrument borrowing. What came to our rescue is that I think what Sudhirji just mentioned on the parameters which were discussed, that we were lucky enough that some people guided us. And I like the idea Sanjeevji mentioned that mentoring and guidance and incubation and facilitation and technical support has to be there for small and medium MFIs to have a very strong board. But in today's time, to get independent director is such a big challenge because it's a full liability for the independent director. And one indicator is that out of, like in Mitrata, we have 5 board members, out of which 3 are independent and 2 are the promoters. It means 60% are the independent, is an indicator of transparency, because no independent director will lend their name now to an MFI which is either not robust or which doesn't have systems in place, because nobody would like to put their reputation at risk, or now even the liabilities of 100% of the independent directors. Of course, if you have strong board, they will not be just silent observers, and they would not like to keep silent, and they will demand audit committee, risk committee, remuneration committee. And then as a promoter, you start realizing you are an employee in your own promoted company because it's the board which is running the company. And this could be so difficult for a promoter to reconcile with. But that's what professionalism is all about. That's what the sector demands. I should forget, I am a promoter. My net worth is increasing. My share value is increasing. My as an individual, whatever money I have invested, that will grow if the company will grow. But my accountability is to my board. My accountability is to my customer. My accountability is to my lenders. I think the second part which has been mentioned about the cuts of the portfolio, different data and the different cuts. Believe me, we need to have a very strong team to do that. It's not an easy job. First, you need to have a very strong IT system, and then somebody who can run that IT system to create those cuts. When the Excel format comes to us in which we have to submit the information to our lenders is huge. But if it is system generated, it can be done in 12 to 24 hours. If it's manually being created, it will take months and it will not be accurate. So do we have systems to help us to meet the expectations? And again, I'm repeating, the expectations are not unreasonable for sure, but I need to be equipped to deal with that. I think this is something which is not a one-day affair in terms of achieving the standards which Sudhirji has mentioned. It's an everyday effort, and I think as a managing director, to be honest, I don't run the company. I'm not into operations involved at all. My CEO is doing that. My job is to ensure that the expectation of our regulators, lenders, my board of directors, I'm able to meet that. And that is where, if as an MD, I am also the operating officer, I am also the audit head, I am also looking into IT, I am also looking into this. Of course, to hire people, it will be a cost to the company, but it's a very wise investment. as small and medium MFI, we bleed out when we hire people. It's not easy to hire people and to pay salaries. Our OPEX goes high. But I think in the long term, that is very, very, very useful. So I would say that all the parameters which has been mentioned, right from the governance to the operational to the financial transparency to the systems and procedures. One of the most ignored department is the internal audit department. And I believe that is the best thing any MFI can have. I think I've heard stories, I have been told by my employees who came and worked with us, that this is one department which has always been sidelined, ignored, not to make it prominent because it directly conflicts the operations and the growth of the company. And the second is the credit underwriting department. Mr. Sanjeev Singh was telling about the credit underwriting. But same way as you are cautious, we have to be very cautious about credit underwriting. Now, these two departments are absolutely putting brakes on operations as far as, mad growth, what we say, or the mad rush. Now, this is where the blessings of the board and the promoters have to be on these two departments. My love should not be for operations department. My love should be for internal audit department, risk department, and for the credit underwriting department. I think they need to be prominently placed within the organization. And if I have to put my money, I will always put my money on these departments. So just in the nutshell, because I think time is also a constraint, to put it together, I think there is no debate or discussion about it. If we as small and medium, and from small to medium and to large, I think the parameters what Sudhirji has mentioned applies to all of us. It doesn't apply only to small and medium to begin with. Let me clarify. It applies to any institution dealing with money, and trust of the people and of the lenders and of the investors and of the customers. So it is need of the hour. This need to be done. But yes, lot of support, lot of facilitation will be required, and it comes with a cost. And I think there should be some positive affirmative facilities available in terms of incentivizing small and medium MFIs, that if Sudhirji is putting a tick mark and saying this MFI is doing good, small, then somebody should come and put a pat on their back by way of not only they get money, but they get little incentive. There should be support available to them and a little more recognition and identity, which gives some encouragement to sustain their motivation. But it is not a choice with us. We have to do this, and this is the only way we can grow and sustain a sound institution. So I'll stop here my submission. Thank you.
Yes.
Thank you very much, Akhil. One of the things I always like your deliberation of that when you were talking about this internal audit and harness the growth. And it has to be very sane growth. I totally agree with you. And if we do that one, I think it will also help us to be transparent because you do have the data. You are telling that I have harnessed this one. You are telling that, okay, fine, internal audit is telling this one. I totally agree with you. And thank you for this one. Now I will come to a person, Shuman Chaudhary. He is the balance between these two. And he understands the requirement of the microfinance institution. He understands the requirement of the bank, and he is the rating agency. He's these observations and he's like this report is very, very much significant in the process. So, Suman, I would like to understand from you about the parameters. I want to understand from you what prohibits the smaller institutions to get fund. And third thing, possibly you also get like what Mr. Singh was telling that we should not be equating between the big and small. Then what are the special thing the mid and small MFIs do, which is making them a kind of this significant this link between the development of the people and the banking industry. Over to you, Suman.
Right. Am I audible?
Yes, very much.
Okay. So thank you so much to Sadhan, and in particular to Saibal, Mr. Maman, and Sangeeta. I have been participating in some of the Sadhan events for some time now, and it goes back a few years. So it's always a pleasure to come back and participate in these very interesting discussions, which are very relevant for an orderly and healthy development of the microfinance sector. I think this theme of transparency is extremely relevant in today's, kind of environment. I think you all know that RBI has been focusing on transparency, disclosure, better systems and processes in the financial sector for some time now. And I think if you, I'm sure all of you follow some of the regulations or some of the actions that are coming from the regulators, particularly RBI. And it's not just about microfinance organizations. It's about banks. It is about NBFCs. So it's that theme of, again, of transparency and, ensuring that the data which is getting reported is of the highest standards. I think that is what is occupying the minds of the regulators right now. It's an extremely relevant theme today, even for, always for the comfort. It has always been a matter of comfort, this element for rating agencies and lenders. And I really thank Sadhan for bringing it to focus at this point in time, because ultimately lending comfort and funding will surely going to be linked to the quality of transparency and disclosure. Before I think I begin and respond to Shaival's questions, let me just, I think you all know that what Acuity is all about, but very quickly, we have been actually as part of SMERA, and we have been doing microfinance grading and code of conduct assessment for a very long time. And we have been also doing bank loan ratings through Equity. For over 50 to 60 microfinance organizations, we have done bank loan ratings for several, I think for more than 5-6 years now. So that gives us a certain perspective across the board. And the good thing about our portfolio is that we have a larger proportion of mid and small microfinance organization. So that gives us a certain kind of perspective on this part of the sector. So, I think the first thing I would say is on transparency is that it's all about a lot about it is the quality of data. It is about the availability of data, as I think Sudhir has already discussed, and the quality of the data. What is available? A lot of the things that I can share as being part of an analytical team for a long time is that rating analysts typically they get a little uncomfortable, for example, when there is data inconsistency, right? I'm just giving some anecdotes so that it's easy for people to relate to and understand. So, for example, you kind of get some data on days past due. That's the delinquency or days past due in certain markets, and you have some set of data on NPAs. And if the analyst is not able to kind of relate both the sets of data, that there is something on days past due and delinquency, but NPA is saying something else. Now there may be a reason for that. There may be there may be some adjustments done, or there is an explanation. But if the explanation is not given properly, or there is no proper checks on the data, or then there is a discomfort, right? Which not only will come to the rating agencies, it will come to the lenders also, as Mr. Singh will agree. So it is very important to ensure that there is consistency of the data that is being provided. If there is apparently a lack of consistency, that is being explained why this is so. The other thing, which I'm sure Sudhir, who is my ex-colleague, will agree, is that one important issue, in financial sector, in NBFC, is the definitions of these terminologies. Now, unfortunately, there is no standard terminology or standard definitions that is across. Of course, there are some most people follow certain terminologies, but let's say delinquency definitions, and how do you actually define delinquency? There are, what we have seen is that if you go a little in depth and you ask them, okay, what's your definition of days past due? What accounts have you included? Have you excluded some account? What is the treatment of rescheduled accounts? Right? So there are issues around this, because of which sometimes apparently some companies' numbers may look better, but in reality we are comparing. It is possible that apples and oranges, because the definitions of delinquencies are not standardized. So these are issues that I think at an association, at a southern level, or at a regulator level, things need to be a little more refined, where the whole ecosystem is working on standard definitions of all these matrices. There is no scope of interpretation. There is no scope of doing some adjustment. I think that will help really in bringing more comfort and transparency in the whole system as a whole. It's not just about a company, but it is about the system as a whole. Because this is I can share with you, and Sudhir will also agree with me, that rating analysts sometimes struggle with this, because they need to compare across companies. But this comparison sometimes get a little bit clouded because we are not sure whether everybody has followed the same definitions. Have they adjusted for X? Have they adjusted for rescheduled accounts? Somebody has included return of accounts. I'm just giving an example. Somebody has excluded return of accounts. How do we really compare? So I think this becomes a very important aspect. If we really are able to push through a standardized set of well-defined set of matrices, which can be used by lenders and rating agencies, I think I see a lot of ecosystem improvement that can happen. So that was one of the important things that I wanted to say. I think the other thing is on some of the things that Saibal asked me about the methodology in general. I think Sudhir, what he captured is actually broadly true for most rating agencies. You do look at financial sector entities very similarly, because there is a general criteria, right? But the point is that there are certain things that need to be a little fine-tuned when you are looking for medium and small institutions, because they, for example, if you are talking about AUMs of 50 crore or 100 crore, you cannot really expect them to be diversified into 7, 8, 10, 15 states, right? They will be concentrated typically in one state, maybe a few districts or two states. Two states, 10, 12 districts. So our methodology, our specific methodology is a little fine-tuned to that, because we believe that it is concentration risk is an important risk. One cannot take, kind of deny that there can be events which can impact certain regions. That's the reason one looks at concentration risk. But you also have to offset that with the kind of familiarity, or the lender familiarity, or the lender's track record in a particular geography. So we have seen some smaller lenders, microfinance lenders, who have done excellent work in certain districts in a particular state, and the delinquency track record is also pretty good. If you forget obviously the COVID period, but apart from that, it has been pretty good. So we are not, therefore, only going to, kind of drive a particular view or a rating only by the concentration part. There are other aspects that we are going to see. We are going to look at processes and systems. And sometimes it is not only about technology, it is also about the philosophy of the management, and how the management is, kind of growing the portfolio, and what kind of risks they want to take, and what kind of risks they don't want to take. I think that's why the risk appetite of the management is very important element for a rating agency to assess. Uh, Coming on the part of uh, I think there's some background noise. I hope I'm audible.
You are.
I was just talking about this data part. Now, I think Dr. Khan mentioned about this point that it's a very capital intensive thing. Technology today, it doesn't come cheap. What we understand that I wish we had more low cost technology available. But the reality is technology is expensive, and therefore it is sometimes difficult for a small and even medium-sized microfinance companies to afford that kind of technologies, which can maybe end-to-end, which can kind of give you that wholesome data collected across all centers, which can be, again, you can extract whatever data you want. So that doesn't come cheap. And that is, of course, something that we rating agencies, lenders would really want, that because that will put the microfinance organizations at par. Today, that probably is becoming a differentiator. The large microfinance companies are able to, for example, what I hear from people who go, some of our people who go to the branches and they go to centers, that there are obviously bigger microfinance companies who have those tabs. They have tabs, right? And so digital, so they have data of the centers and all the customers. But there are others who don't have it. That's the reality. They don't have tabs because that's expensive. This smaller one, they will just get a mail from their head office saying that this is all that either probably that needs to be collected. So the use of technology is becoming a differentiator. Unfortunately, it needs resources. And this is something I believe maybe this is beyond maybe the scope of this, but this is required that there has to be some thought process of how technology can be available, maybe at a little, a little cost-effective manner, or some kind of a subsidy framework for use of technology, which the MFIs, the small and mid-sized MFIs can avail of, because technology can change the whole environment of transparency and data comfort. And that is why I think this is required to be made available to the smaller and mid-sized MFIs at a reasonable cost. So that's one point I also wanted to bring to the table. If there is anything else, please, I will be happy to answer. Thank you.
Thank you very much, Suman. So you have actually, deliberated on this quality and availability of the data. You have also talked about the consistency of the data, which I think Sudhir is also agreeing with that one. And in his document, definitely it is there as, I have seen that one. Then avoid justification and, this your adjustment and interpretation. It has to be in line with the definition. Totally agree with you. Totally agree with you. And it also helps us to bring the transparency. And you can also compare it with the industry averages. So it will be, it will be helpful for us. Yes, I also agree with you that, in many cases that lenders need to understand that, this if the portfolio is, lesser portfolio, small MFI, it cannot go to 10 states. There is a risk, but if we see that, in order to give you understanding that every month from Sadhan's end, we send the information to our members on the risk parameters of geographical risk parameters. So it is, it will be helpful for this to understand whether if it is concentrated also, then it is riskier or not, because the parameters are already available, the reports are already available. Yes, low cost technology, one thing, we have already sent a proposal to one of the DFIs of India to develop this low-cost technology for the smaller institution. We have already started working on it. We have started working on it from long back, understanding this one. But it also takes a bit of time to raise the fund and also work on that one. So yeah, so that's what it is. I think it is already 4:26. One of the things I could understand that one thing that Umar is here, Mr. Umar from SBI. Umar, are you still there? I've seen Umar.
Yeah, IDBA also.
Yeah,
also.
tell me.
Yes,
Yes, I'm there.
Yeah, Umar, what's your observation on this? Umar is looking after the portfolio of microfinance. Umar, yeah, good to see you, Umar.
Hi, hello. It's
Yeah,
there's
hello.
somebody from IDBA also. Okay.
Yeah, I have seen. I think he has left.
He's left. Okay.
From ICICI was also there. Yeah, Umar.
Yeah, good afternoon. I'm very happy that you have organized such an important, informative session for all of us. At the very beginning, say MFI is no doubt playing a very crucial role with the portfolio of 4 lakh crore. There are almost 3-4 important contributors are there. Banks are there, SFBs are there, and then MFIs are there, NBFC MFIs are there. So banks, they have got their own funding. SFBs, they have also got their own funding. The problem comes here for MFI, NBFC MFI, those who are unable to generate their own funding. They are unable to take public deposit. So they are totally dependent upon external fundings like banks and other institutions. So as a bank, the State Bank of India recognizes their need, and we are very open to accommodate all MFIs, NBFC MFIs. So we have got a scale-based assessment in our bank. Those MFIs which are having more than 100 crore AUM, there is different scale for assessment. MFIs which are having less than 100 crore AUM, 50 crore AUM, 5 crore. We cater to all segment of NBFC MFIs. So in State Bank of India per se, we are very much cognizant of their requirement. Based on that, we have devised our own internal assessment mechanism. Coming to say the theme of the session, a theme of that this session you have organized, that concerns basically what are the concerns to bring in transparency in MFI lending. So in our bank, whenever we put proposals to the committee, we always find that they have got some sort of apprehension. So the first and important is that whatever it is told, that transparency and data quality, and then the casting of their financials. In one very common apprehension they have got, that PAR portfolio of many NBFC, they show a very stellar performance. So our committee always asks whether this PAR portfolio or delinquency which is being shown by the MFI, whether it is in sync with the reality. So actually, as per the data, we could be able to convince, but the perception is that this may not be true. So I just want to understand how we should convince our committee that whatever they are showing there, it is absolutely without any doubt, and it can be trusted upon. So any thought on this particular point? Anybody?
I think Akhil sir, you are the right person to say.
Yeah. No, I think the responsibility of MFIs is to provide the data, and I think the transparency demand that the entire dump can be provided, and that can be extracted. We can give the consent to have access to our database, because you can have access to our database. The consent is given. The lender need to have the capacity to then run through it through the systems, but that's also a limitation, that who will sit in SBI to analyze the data of a small and medium MFI to see whether there are discrepancies in data or not. But some of the lenders have been taking consent from the MFIs, that can we have the entire dump rather than you producing the, Excel sheets for us, and we'll be extracting out of it. That is one. And I think the data has to be supported by the field due diligence. Just by sitting in the room in front of a computer, I think the processes part, which gives the confidence to the committee, also comes from the, the center meetings and the CGTs and the GRTs and the home visits and the credit underwriting. But yes, to answer your question, Umar Saab, that you have access to our data. Transparency demand, we give you 100% access. We are ready to give 100% access. I don't think any small medium MFI will shy away from it. And you need to have institutional capacities to run the algorithms and analyze it and see if there are any makeups or faults or any errors in that data.
Let me just add one more point to that. See, the process in the microfinance sector, the lending structure in the microfinance sector, revolving around the joint liability concept, that brings a lot of pressure or kind of a compulsion on the part of the borrower to make the payment. And she also knows that once she completes that cycle, she'll be also getting a higher level of borrowing, higher level of financing from the bank. So that also gives some kind of a compulsion in her. So that's the reason why the recovery has been good. But during the COVID time, it wasn't good. When the situation was bad, it wasn't good. When demonetization happened, it wasn't good. But in the normal situation, it is always good. Whether it can be 98 or 99, but there could be 1 or 2% difference, but then it is as good as, much better than any of the lending happening in the banking system.
Gigi sir, I must mention here a request to the lenders who are here and also to the rating agencies. Please don't give up on trust. I think if we go with this mindset that the information being provided is fake or wrong or with discrepancies, this is going to kill the entire ecosystem. Of course, if there are discrepancies that need to be notified, but we cannot start with an element of doubt. We cannot start with an element of mistrust that what is being shown is, or what is being given is manipulated. Of course, the technology is available to identify the manipulations and flag it, put the red flag. But this whole perception that if it is small and medium, it's bound to have discrepancies, bound to report wrong data, and on the bigger ones won't do that. One, we should not be doing it. And secondly, please, my request is to trust, to begin that trust, but not to compromise or dilute the due diligence process. Of course, that is also very, very important.
If I can just add to what Dr. Akhil mentioned, Saibal, if I'm permitted, I just wanted to add or maybe
yes, please.
My part of this. I completely agree with Dr. Akhil that we can't, as an analyst or as a lender, anybody for that matter, when we look at the data, we can't start with a bias. The best way we can underwrite or analyze is to start at an unbiased level. So we should do that. It's a fiduciary responsibility to do that. And we have this culture, at least, that we want to make sure that we have understood the data. And, there is a rating committee, rating agencies operate at a rating committee level, that the rating committee assigns the rating. And rating committee will ask questions on the compatibility or the consistency of data. So it's very important that the analysts satisfy themselves. And it is also very important for the clients, I mean the microfinance organizations, to satisfy the analytical team that the data is trustworthy. Yes, there can be some limitations because of technology, but we are very confident of what we have presented, and we can explain whatever questions the analysts have. I think if that can be done, and it's going to definitely add to the comfort of both the analyst as well as the rating committee, I'm sure, and that will be reflected in the rating. Now, one of the things, this is just being an analyst for a very long time, I can tell you, one of the things that any analyst, for example, in a rating agency, they don't like at all is surprise. Surprise. This word of surprise is very important. Surprises means you have seen something, you're expecting something, suddenly something comes out, some press release comes out, or some data is given, whole thing is topsy-turvy. That sometimes creates a big impact, upheaval, and can, as Dr. Akhil said, raise some level of trust, mistrust, which is not only related to one entity, then it kind of covers the whole ecosystem. And this is exactly what has happened, and it is not about rating agency. This has happened in the whole financial ecosystem. Believe me, after ILFS. After ILFS, there has been huge impact, and we all know, in the ecosystem. And we are now trying to address some of these concerns through improvement in transparency, improvement in the quality of data. So this is important. And the other part which I wanted to just say, this issue of data quality, believe me, is not related only to small entities. We have experience of weak or inconsistent data quality in very big NBFCs also. Unfortunately, and that is the true, that is the way the rating, all rating agencies framework has. There is one standalone rating framework, and then there is a notch up. You would all know. And so what happens is many microfinance organizations, if you see the rating distribution, you will see that many microfinance organizations, some of them are in AA category or in high A category. Most of them are unlikely to be such a high rating only with the standalone rating. They must be having a group support there. They must be having a parent support there. It can be a gold loan company. It can be some big group which is supporting them, which is giving them the rate that, that push, which is called a kind of a notch up in rating agency parlance, because of which they get a better rating. So it's not really a reflection that some of the bigger microfinance companies are really operating better. They have better rated. That's an advantage, yes, because of which they're able to access funds cheaper and they're able to grow books faster. But the important thing, I think, for all the regulator and the ecosystem to understand is the ability to raise funds and ability to, grow the book fast doesn't always mean a healthy ecosystem, because you can always run into a risk when you are at a very high, let's say, portfolio AUM of 15-20,000 and you are growing at 20-25% per annum. That can be a risk in terms of the kind of growth that you are pursuing. So it's not necessary that only large microfinance companies can mitigate risk in the system. It can be the other way around. So I think everybody has to really think about this. It is about measured growth. It is about getting the trust and confidence of the system regarding the data. I think if these things are addressed, I think there will be a far more healthy growth that will continue for microfinance.
Very right.
So-
Very right. Yeah.
Mursa, anything
Sure.
more?
Saibal, I can add.
Yeah, so
Yes.
No, let's complete that. Let's complete Umar. Ajay, Sudhir. Ajay.
Sudhir wants to tell something. Yeah,
Yeah,
Sudhir, please add on.
Umar sir, our committee, I will not name the organization, way back 20-25 years back, when we are tabling a report of microfinance to our committee member asked the same question, saying that how 99.9 percentage collection can happen. And we told the committee members saying that please visit the field with us. We have to leave at 3 o'clock in the morning to go in the field at 5 o'clock. 5 o'clock collection starts. Please see how it happens. And you'll not believe, there were committee members who visited with us and they understood the model, how it works on ground. Okay, that was I'm talking about 2001, 2002. When we had tabled the report to the committee, the first question was, it is impossible that 99.9% collection can happen on ground. That to an unsecured, portfolio, unsecured borrower of 10, 15. At that point, it was 10, 15,000 rupees, and it was weekly collection happening on ground. Okay, so that's the trust we built up over a period of time, and then I've been associated with this industry for so long. So that's how we did it when we want to build the trust. So I think some of your committee members can travel to various MFIs and then see how it happens on ground. It is a fabulous process. Even the best asset quality, maybe the banking sector, the best asset quality, maybe various others, even that will be get beaten in terms of collection efficiency. there are certain instances which is right. That's a process over a period of time. The organization, the sector evolves. That's how we have seen a couple of bumps. But I think the microfinance sector has taken that in the right spirit and then moved ahead in that particular direction.
Sudhir, if I can just add, sorry, Sohibal, but if I'm just wanting to add to this, is that what you said is absolutely right. In a normal situation, and I think Mr. Mammon also said, in a normal environment, if you have the JLG model working fine, your collections will tend to go towards 100%. In a normal situation, nothing goes wrong. It is only, and that is one of the unique nature of this microfinance business, that if what happens is when some event comes up, then the numbers will turn topsy-turvy. It will get volatile. We saw it probably during demonetization, or if, to start with the Andhra Pradesh crisis, then demonetization, then COVID. So when some of those events hit you, then you can see suddenly a jerk in the numbers. But normal conditions, collection efficiencies tend to go towards 100%. This is our experience. So that volatility is something that can be there, that at the back, but normal situation, it should be very healthy.
That's right. And then second question we keep on getting it, that is from my committee, that they say this sector is very competitive, right? There are multiple players in this sectors. When this sector is very competitive, when large number of players are there, then why the ultimate borrower's rate of interest is not coming down? This is the question they ask it. Say, for example, they give when the housing sector is very competitive, there is the razor edge competition, and then the thin margin is there. Rate of interest is very fine. Similarly, when this sector is so, why it is not happening?
So, I mean, this is a very, what do you call it, like very common question for all of us. So, I mean, Akhil, it goes to you.
Sure. I think it's a fundamental question raised by Omar Saab. Rate of interest depends on multiple factors. And this is what is being discussed in many recent forums we have been having. First question, I'll answer your question by asking a few questions. Can the rate of interest being charged to a small and medium MFI be the same or more compared to a bigger MFI? Big MFIs get money at a much cheaper rate from the banks because of their rating compared to small and medium. Whereas the OPEX, the operating cost of small and medium, is very high. We need to invest on technology. We need to hire good competitive staff. We have huge operating costs to begin with. It should be other way around, which I have been raising flag on all platforms, that please reverse this. The lending rate to the small and medium should be soft, so that we can, we can be part of the mainstream to begin with. One. Now, I just answered to Mr. Sanjeev Singh also that during the credit guarantee scheme, the small and medium who got the money from the banks, who got it, some of us were lucky ones, we passed on 2% benefit to the customers, and the customers were happy and we were happy. That you cannot make money by charging higher rate of interest. In microfinance, it's all about the scale and the volume and the growth you have. And also to control your ambition, how much profit you want to make, or at what rate, as Sumanji said, you want to grow. So I think on the rate of interest, if the lending rate goes down, the rate of interest to the end customer can go down. Answer to your other question is, can we have the same rate of interest for a debt for a wash loan, water and sanitation loan, as compared to the income generation loan? But I am getting wash loan expensive than income generation loan. Can you believe that? That some of the NBFCs or some of the institutions are charging higher rate of interest for wash loans. I beg to them that at least give wash loan cheaper so that I can pass it on cheaper to the customer, because they can afford a toilet in the villages, or they can have a safe drinking water. So I think unless all key players of the supply chain, right from the the people who are giving the money, the people who are, we are the mediators. I always say we take the money, pass it on, take it back, pass it back. I think the interest rate has to be balanced out in the entire value chain. And of course, we have to work on our efficiency, productivity, operating costs. We have to reduce that down to bring the rate of interest down. I have already, some of us, not just Mitrita, but some of us have passed on 50 basis point benefit to the lender, to our borrowers on the wash loan. Though I'm getting expensive, but I feel ethically wrong to charge same rate of interest as income generation loan. So 50 paisa less for the wash loan. That may hit my profitability, but it's not making me losses. I'm still a profitable institution. Only I'm controlling my greed, ambition of, not the greed, the ambition of what profitability I want to book. But rate of interest won't come down until unless the lending rates and the operating costs, and there has to be some support for the small and medium during the incubation period, what we say till we reach 250 crore, 500 crore, whatever window we are talking about. Subvention has to be there, and that subvention benefit need to be passed on to our customers.
I'll just add one more point here. In fact, the question you asked was that because of the competition, why the rates are not coming down. See, the point here is that, see, the borrower is always in need of money, and no institution is not able to give the full requirement of the person. So it is not a choice between X or Y, it is X and Y. So they need from the X as well as they need from the Y also. So because the credit needs are not addressed by one but single entity. If it is being entirely addressed by one particular entity, probably things would have been different. But that is not the case as far as microfinance is concerned.
Yeah, to add on that one, that we do have experience of NSFDC. NSFDC is giving us money at 5%, and they are giving us like 10% for our operation cost. So at the end client is getting at 15%. So we do have that experience also. And I'm totally echoing Akhil, that if our source cost is lower, then definitely we'll be passing it on to our end clients. I mean, that's our experience is. And Umar, to inform you that the smaller MFIs, they are getting most of their funds from NBFC, and it goes as high as 17-18%. It is, but at the end of the day, we have to support those unreached clients. For this financial need. Otherwise, who will do that one? So this is where we are standing. We are standing in this crossroad, and
Saibal, I
wants
want
to
to
just yeah, but
Saibal, I want
it
minute.
has to be very brief.
Yeah, just a minute. Yeah. So, Umarji, what we have done is that we in 2017, in 2018-19 with Sadhan, we have done an analysis of margin spread for mid and small MFIs. We have looked at financial statements of around 45, 50 mid and small MFIs. The margin spreads for them after all the operation cost and all the costs is just 0.75 to 1.25%. Okay, because as we mentioned that high cost of borrowings, and they themselves are competing, and the borrowers are also saying that I am getting lower cost from some other MFI. But if we have the study which we have done is that's what when we were looking at Southern a couple of years back, we were saying that whether we need to have a differential grading mechanism for mid and small MFIs, so that we can demonstrate to the banking system that these are the institutions who are doing well, profitability is there. Their intention is to collect money at the doorstep of the borrower, should not be at a pain point. So this analysis shows that though interest rates you believe the interest rates are high, the margin spreads are very limited. That's what I want to add. Yeah.
I think we have to. It is already 4:50, and we have other meetings. Thank you all for this time. And it's very interesting discussion, especially in the side of data clarity and your transparency. And most of you have echoed the same thing from all the sides, that yes, data has to be there, the support system has to be there. There should not be apprehension. I am extremely thankful that Suman has built up the reality, that what exactly is there, that small doesn't always means that non-transparent. Yes, I agree with you that a couple of areas we need to definitely improve. What Sudhir has, I mean, all of you have agreed that Sudhir's document and the parameters are good enough, and we have to build up on that one. Possibly, if we follow the parameters what Sudhir has built up along with our these institutions, maybe we will be better in transparency, and the lenders will have a comfort on for lending them. And I mean, this is what we could learn, and it's a good one that when we are talking about quality, availability, consistency, everything, and mentoring and handholding. Akhil, you know that we are always there to support the industry, always over there. And it is good discussion. Over to you, Mr. Maman, for your closing
Yeah.
remarks.
No. I think we are already overshot the time, almost 2 hours. It is 2 hours and 1 minute. Okay, we had been discussing for 2 hours and 1 minute or 2 minutes now. So thank you so much for sparing your time and keeping almost everyone continued to be here on the forum discussing the issue. And it's a good thing to see that everyone is equally agreeing to the idea of having a much transparent and much stronger organization to be built. And I think it's our responsibility as an association, as an SRO, to see that the sector is built in a much transparent manner. And I'm sure the document which Sudhir has prepared will help in contributing to that. And thank you, Sudhir, for putting your efforts and creating a document which will be, I'm sure it's useful. As Akhil Saab said, he wished this should have been there 10 years back. So at least from now onwards, if we can have this, the future generation or the present ones can also make use of that. So thank you so much, and thank you, Singh Saab, for being here throughout the period. Omarji and Suman, everyone. Sudhir, of course, you, the Akhil Saab, you have been part of our journey, and of course, Anjanda was also there initially. I think probably must have left at some other meeting. So thank you so much, and we will be shortly coming out with a document which would be made available to the public so that it would be useful to everyone and make use of that. Thank you so much.
Thank you so much.
Thank you. And finally, before exit, I just want to add that what Mr. Akhil was telling, that can a small MFI and a large MFI get the same rate? Unfortunately, as of now, no. But with the change of policy that I recommended, if something comes from the RBI as a documented approach, definitely you are going to get the benefit.
Great.
Thank you.
Mr. Singh, I will be coming back to you on the policy side.
Thank you.
Thank you.
Thank you very much.
Thank you.
Thank you. Thank you, all of you. Bye-bye.
Thank you. Thank you.
Thank